We now take up the third part of partnership topic, that is amalgamation of firms. The name indicates when two or more than two partnership firms, when they merge together to create a new firm, we call it as amalgamation of firm. What does this mean? It includes closing down of at least two firms and incorporation of a third new firm which was previously not there in the market. Two firms which are closing down, their accounting can be done by either of the two methods, revaluation method or realization method. We will do it by revaluation method, and the topic to come next, conversion of firm, we will do by realization method. So you have both the methods known to you. Whichever method you find comfortable in exams, you can go ahead with it. The content will be what they can ask you: selling firms, journal or ledger accounts, and purchasing firms, journal and balance sheet after new incorporation of the firm. Let us see the theory aspect. Amalgamation of firm, this is a combination of following two events: dissolution of two partnership firms and formation of a new firm. Here, business of two partnership firms gets closed down and a new firm is formed, which takes over all assets and liabilities of old firms. And the partners in the old firm now becomes partner in the new firm. Suppose AB and company and CD and company, two old firms, when they get merged, they make a new firm called as AB, CD and company. Partner AB and partner CD will now be partners here. All assets and all liability of both selling firms, preferably all, will be transferred to new firm. Accounting treatment in old firms. Since the business of old firms is getting closed by any of the following two methods, revaluation or realization, we will be going by revaluation method. Following four accounts are normally prepared: revaluation account, cash bank account, partners capital account and new firm account. Steps to close the books of the old firm. Step 1, transfer partners capital and current account balances to partners capital account and current account. Transfer undistributed profit or losses to partners capital account in PSR, something like dissolution only. Step 3, transfer cash and bank balance to cash bank account. Step 4, transfer all the assets and liabilities taken over to the new firm account at their agreed values, because new firm is taking over at agreed value, which may be more than book value, which may be less than book value as given in the question. That is what we are thinking about the revaluation aspect. The difference between the old value and agreed value should be transferred to revaluation. You know it. CA foundation, admission, retirement you did, even death. Revaluation account, debit side will show decrease in asset, increase in liability and increase in provision for doubtful debts. Credit side will show increase in assets, decrease in liabilities, and last one will be decrease in provision for doubtful debts. Step 5, dispose of assets and liabilities not taken over by new firm. So those assets and liability which new firm is not taking over, our firm is getting closed. So we will sell them. Dispose of means realize them. Step 6, raise or write off goodwill by using partners capital account in PSR. The same as what you did in CA foundation, application of AS 26, accounting standard 26. Raise it, write it off, merge it and pass the net entry. Close revaluation account and distribute profits and loss in PSR. Close partners capital account and cash bank account and transfer balance to new firm account. The new firm account was tally. So this was the basics for revaluation account. Let us take and go ahead with the questions part of amalgamation of firm. I repeat, We will be doing it by revaluation method. The topic to come next, conversion of firm, we will be doing by realization method. So, basic introduction gets over of amalgamation of firm. We start with the first sum for amalgamation of firm topic. In a similar type of business, Naveen and Vasant are in partnership as Western Trading Company, Das and Chatterjee in Eastern Trading Company. It was mutually agreed that as on 1st April 17, the partnerships be amalgamated into one firm called as East and West Company. So, first firm is Eastern Trading, Western Trading, they both are merging, and the third new firm they are creating is East and West Company. The profit sharing ratio in the various firms were and are to be: old firms Naveen and Vasant 4:3, Das and Chatterjee 3:2. New firm, they all four are partners in that 6:5:4:3. As on 31st March 17, balance sheet of the firm were as follows: Western and Eastern Trading Company, liability side, capital Naveen, Vasant, Das and Chatterjee, creditors and bank overdraft, assets, property, fixture, vehicle, stock, investment, debtors and bank balance. The agreement of amalgamation contains the following provisions. These are the adjustments which are to be considered while passing entry for merger or amalgamation. Provision for doubtful debts at 5% to be made in respect of debtors. So, we make tick mark on both debtors. They are subject to creation of provision for doubtful debts. Next, provision for discount receivable at the rate of 2.5% to be made in respect of creditors. So, on these two creditors, 2.5% will be our RFDC, reserve for discount on creditors. East and West Company to take over the old partnership assets at following values: stock, vehicle, fixtures and property. See, stock of both firms are taken over, so tick mark on both. Next, vehicles also of both firms are taken over, tick mark on both. Fixture only of Western Trading Company, that means fixtures of Eastern is not taken over, so cross mark. Property only of Western 1 lakh, that means property of Eastern is not taken over, and goodwill which is not there in the balance sheet is 63,000 and 45,000. The property and fixtures of Eastern Trading Company are not to be taken over by East and West Company, so not taken over by the new firm, and these were sold for rupees 1,35,000. So, both which were not taken over are now sold for 135 cash, and the same was taken over by the new firm. See, both these assets 1,14,000. So, book value was 1,14,000 and we are selling them at 1,35,000. That means there is a profit of 21,000. Here you can easily see a profit of 21,000, and that is sold for cash, and that cash is taken over by the new firm. Vasant to take over his firm's investments at a valuation of 7,600. That means these investments are also not taken over by new firm, hence it is taken over by a partner. Goodwill account is to be written off in the new firm. So, in the old firm the goodwill is there, not in the balance sheet, but the time of amalgamation is taken care of. In the new firm it should be written off. The capital of East and West Company should be 5,40,000. So, new firm's capital will be 5,40,000 and to be contributed by partners in their profit sharing ratio. Any adjustment to be made in cash. Prepare ledger accounts in books of both old firms. Journal entries in books of East and West Company, that is a new firm, and balance sheet of East and West Company. A big sum every part of amalgamation of firm is touched here. First, ledger account of two selling firms. Which were the two selling firms? First selling firm was Western Trading and then Eastern Trading. Let us start with the solution. We start with the solution. First selling company is Western Trading Company. So, I will give heading here, ledger of Western Trading Company. Ledger of Western Trading Company. First account, revaluation account. Second, cash bank. Third, partners capital. How many partners are there? Two partners. Who are they? Naveen and Vasant. Naveen and Vasant. And the new firm. What is the name of the new firm? New firm is East and West Company. So, new firm East and West Company account. Let us start with the posting aspects. We start with the balance sheet given in the question of the Western Trading Company. Capital of Naveen and Vasant 1,53,000 and 1,10,000 will go to capital account credit side by balance brought down. Naveen 1,53,000 and Vasant 1,10,000. Go ahead. Next, Das and Chatterjee will not be affecting now. Creditors 52,000. This creditors of 52,000 has an adjustment. Then on this creditors we are creating a reserve for discount on creditors of 2.5%. Of course, creditors and reserves are shown separately. So, I will show these creditors to be taken over by the new firm. When new firm is taking over creditor, my entry will be creditor account debit to new firm. So, it will be on the credit side by creditors account. How much? 52,000. Okay. Next, bank overdraft, not there. Assets, property 74,000, and on that 74,000, look at the working note, the adjustment part. What is the agreed value of property? Agreed value is 1 lakh. So, it is taken over by new firm. So, 2 property amount 1 lakh. Book value was how much? 74,000. Agreed value is 1 lakh. That means going up by 26,000. There is a gain for us. So, revaluation credit side by name of the asset is property. So, by property account amount 26,000. Next, after properties, fixtures, book value is 18,000, adjustment is saying 16,000. So, coming down by 2,000, it is a loss. So, revaluation debit side 2, name of the asset is fixtures. So, 2 fixtures 2,000, taken over at what price? 16,000. So, it will go to new firm debit side 2 fixtures at what price? At 16,000 fixtures. Next one, vehicle, book value 30,000, agreed value 28,000. That means we have suffered a loss of 2,000. So, revaluation debit side 2 vehicles 2,000. Second effect, it is taken over by new firm East and West. So, 2 vehicles, agreed value is 28,000. Next, after vehicle is stock 83,000, taken over at 84,500. So, 2 stock 84,500. It is a gain. So, revaluation credit side, buy stock. Varying by how much? On 83,000, 84,500. So, we are gaining by rupees 1,500. Continue. Next, investment 8,000. It is not taken over by the new firm. So, pending. Debtors 68,000. That will go to new firm, debit side, to debtors 68,000, because the effect of provision will give separately on the opposite side. Next one, bank balance 34,000 will go to cash bank debit side, to balance brought down, amount is 34,000. Balance sheet completed. We take one by one adjustments. Provision for doubtful debts at 5% is to be made on debtors. Our debtors were 68,000. 5% means 3,400 is provision. That will go to revaluation debit side, to provision for doubtful debts. What percentage it is? 5% of 68,000. So, it will be 3,400. Second effect of provision for doubtful debts, that will also be transferred to new firm. So, buy provision for doubtful debts. On 68,000 it was 5%. So, amount of provision was 3,400. Same adjustment says reserve for discount on creditors is 2.5%. Creditors are 52,000. When you calculate 2.5%, it comes to 1,300 rupees. It is a gain. So, credit side, buy reserve for discount on creditors. On 52,000, 2.5% will be 1,300. Second effect of that will go to new firm debit side, to reserve for discount on creditors. My amount is 1,300. Continue. Second adjustment, East and West Company to take over old partnership assets at following values. I am taking the first firm, Western Trading. Stock, effect given, vehicle, fixtures, property, all effects we have given. Goodwill will not have any effect, because as per AS 26, goodwill cannot appear in the books. In the old firm, as such it is getting closed, so it cannot have any effect. Yeah, it will indirectly affect our new firm. Adjustment C, property and fixture of Eastern Trading Company are not to be taken over by East and West Company. They are sold for 1,35,000 cash. Same was taken over by new firm. Of course, that is not affecting our solution just now. Wasn't to take over his firm's investments at a value of 7,600. Book value of investment is 8,000, taken over at 7,600. So, there is a loss of 400. So, revaluation debit side, to investments 400. Second effect, it is taken over by whom? Taken over by Vasant. So, it will go to partners capital, debit side, to he is taking over investment. So, he is the receiver, investment is going out, entry will be Vasant's capital account debit to investment. At what price he is taking over? 7,600. Continue. Last adjustment is affecting goodwill account in the written off in the new firm. At present I am not concerned. Proportionate capital 5,40,000 is for the new firm. At present we are not concerned. All adjustments effect given. Let us make the final totaling. First step is to make balancing of revaluation account. Make total of revaluation debit side 2,000, 2,400 and your RDD is 3,400. Okay. When we make balancing of revaluation account, the credit side is heavier, 26,000 plus 1,500 plus 1,300. So my credit total 28,800. Subtracting debit 2. Partners capital account. Underline profit. Who are the partners in that? Naveen and Vasant. So Naveen, Vasant. What are the profit sharing ratio? 4/7 and 3/7. Let's make balancing. Subtracting the debit side, my profit comes to 21,000. When I distribute 21,000, 4:3, that will be 12,000 and 9,000. Give second effect of this 12,000 and 9,000, that will go to partners capital credit side by revaluation account into bracket profit 12,000 and 9,000. Next step is to make balancing of partners capital, because that balance also should be transferred to new firm. So balance of partners capital, credit side is heavier for the first partner, 1,53,000 and 12,000. Okay, that will be my total is 1,65,000. Debit total 165. This capital will be transferred to new firm. What is the name of the new firm? To Eastern West Company. Amount will be 1,65,000. Second firm, it is 1,10,000 plus 9,000 to give you 1,19,000 minus 7,600 for taking over investment by him. So 1,19,000 minus 7,600. So 111,400. To East and West Company. This is my balancing figure. That will go to East and West Company credit side by who are partners, Naveen and Vasant. So by Naveen's capital account and by Vasant's capital account. How much was the amount? 1,65,000 and the second partner was 111,400. One more, cash and bank 34,000. No adjustments in cash and bank. So this cash bank also is taken over by new firm. So 34,000 by, what is the new firm's name? By East and West Company account 34,000. This is also balancing figure. So that will go to East and West debit side to cash and bank account. How much? 34,000. All adjustments effects given, all figures transferred. Last step will be to tally the new firm East and West Company. So you can very well see your East and West new firm will tally at 3,31,800. So it is closing down of the first selling firm, that is Western Trading Company. Now to close down is the second selling firm, Eastern Trading Company. Come on, you try on your own and then we see and cross check your answer. Look at the solution for the second selling firm, Eastern Trading Company. Revaluation account. There is a profit of 12,500. There were two assets, property and fixture, 1 lakh plus 14,000, 1 lakh 14,000 not taken over, and they were sold for 1 lakh 35,000. So there was a profit of 21,000. Here it is. Rest were simple transactions. Cash bank account, credit side started with overdraft balance. Another option can be you can show overdraft as a liability in the new firm. But normally having overdraft as a liability on one side and cash and bank balance on the other side is a bit awkward. No one will do that. Hence, I am adjusting that with cash and bank balance. So net cash balance is 1,26,000. Partners capital, this is accounting. And lastly, your new firm account tally is at 2,62,400. That was the second selling firm. We now start with Journal of Purchasing Firm. East and West Company's purchasing firm, it has acquired assets and liabilities of two selling firms, Western Trading and Eastern Trading. So to start with, journal entries will be all assets taken over from both firms, two liabilities taken over from both firms, and two capitals of both partners transferred to new firm. All these things are readily available in your selling firm's fourth account, that was East and West Company account. Debit was showing all assets and credit was showing all liability. Just merge both firms. Let us start. Date. This was for the firm 1st April 2017. So date 1/4/17. We start with the entries. First asset taken over was property. So property account debit, that is available directly from your adjustment number B. Property is taken over only of the one firm, that is at 1 lakh. After property, balance sheet second figure is fixtures. So fixtures account debit. Look into the table of second adjustment. Fixture is also taken over of one firm, 16,000. Next, after fixtures, vehicles account debit. Look at the table. Vehicles of both firms are taken over, 28,000 plus 13,000. So vehicles are 41,000. Next is stock. So stock account debit. What will be my stock account? Of both figures, stock will be 84,500 plus 63,900. So 84,500 plus 63,900. My amount will be 148,400. Continuing, after 148,400, stock, investment was not taken over. Next is debtors account debit, 68,000 plus 58,000. So debtors are debited by 1,26,000. After debtors, bank balance were there. So cash and bank account debit. After cash and bank, what else? One more was there, RFDC, reserve for discount on creditors account debit. I am giving you a hint, you can write the amounts later on. After all this, assets, liability side, 2. Which was the first liability? Only one. Creditors account. You also had reserve for doubtful debts, there is provision for doubtful debts on debtors, so 2 RDD account, and then all the 4 partners, so 2 Naveen's capital account, 2 Vasant's capital account, 2 third one is Das capital account, and 2 last one is Chatterjee's capital account. My narration will be being business taken over from 2 selling firms were Western Trading and Eastern Trading. So, from Western Trading Company and Eastern Trading Company. Come on, 2 minutes time allowed to you. Write figures on your own in this journal entry. Try on your own. So, look at the entries combining all the assets. Property debit 1 lakh, fixtures debit 16,000, vehicles debit 41,000, stock debit 148,400, debtors debit 1,26,000, cash and bank balances debit by 1,60,000, reserve for discount on creditors debit 2,800, to creditors 1,12,000, to provision for doubtful debts, there is reserve for doubtful debts 6,300, and to all 4 partners capital account. That is the first entry, taking over assets and liabilities of both firms. Second entry will be adjusting goodwill. Application of AS 26 will come here. The typical working note what you have prepared somewhere in CA foundation will come here. Let us prepare the working note. So, calculation of goodwill. We raise it, we write it off, we merge them, and we pass a combined entry. The accounting will go in this way, the table will go in this way. Goodwill, and then amount, ratio, 4 partners. 4 partners are Naveen, Vasant, Das, and Chatterjee. Same way like in CA foundation you are doing. So, first line goodwill raised in both old firms. First firm Western Trading Company. In Western Trading the goodwill was 63,000. The ratio was 4:3. Then in the second firm there is Eastern. It was raised by 45,000. What was the ratio? Ratio was 3:2. And now in the new firm it is written off. New firm's name is East and West Company. $63 plus 45 is 1,08,000. New ratio is 6:5:4:3. When you raise goodwill, you know it very well, partners capital will be credited. When you write off goodwill, partners capital will be debited. We take the first one, 4:3, 4/7, 3/7 of 63,000. So, credit 36,000 and credit 27,000. Nothing in Das and Chatterjee. Eastern will be credited in Das and Chatterjee 3:2. So 27,000 in Das, and Chatterjee credited by 18,000. And now 6:5:4:3 debiting by 1,08,000 rupees. So 18 6 are 108, 6 6 are 36,000. So debit 36,000, 6 5s are 30, debit 30,000, 6 4s are 24, so debit 24,000, and 6 3s are 18, so debit 18,000. This is a combined entry. Now we try to merge them to get the final answer. My final answer will be affecting the goodwill part. Okay, see, credit 36,000, debit 36,000, so nil. Credit 27, debit 30, so it is debit 3,000. Credit 27, debit 24, so it is credit 3,000. Credit 18, debit 18, nullified. So what is my net entry coming over for goodwill is Vasant debit to Das capital account. See the working note again carefully before we pass the journal entry. The goodwill working note is prepared now. Your entry comes as Vasant's capital account debit to Das capital account 3,000. All adjustments over. The last adjustment says you total goodwill should be 5,40,000 distributed among these 4 partners in their PSR. So what to do now? I am giving you a hint, you start. Total capital is 5,40,000 rupees. This 5,40,000 will be distributed to all the 4 partners in the new ratio 6:5:4:3. This will be their new capital. What do you mean by new capital? That is your required capital. It is a closing balance of capital account that you will write in capital account debit side in the last line. Then you will make balancing of partners capital, and partners capital balancing difference will be either to cash bank or by cash bank. What does it mean? The partners whose capital is in excess compared to the required capital, they will withdraw cash, and those who are having a short capital, they will bring additional cash. Come on, prepare on your own partners capital account. Entries till this, make the posting in that. You can simply post amount only, no need to write to and by. Show closing balance distribution of 5,40,000 and find out the balancing figure either to cash bank or by cash bank. Come on, try. Let us see your capital accounts. This is your capital accounts. Initial this entries from your entry number 1. This one is that goodwill entry. After that goodwill entry, writing these closing balances which you already done in capital adjustments. 5,40,000 distributed to new partners in new ratio, and after writing these closing balances, you make balancing of each partner either to cash bank or by cash bank. For 3 partners, Naveen, Vasant and Chatterjee, it is by cash bank, and for Das it is to cash bank. Got it? So what will be our journal entries coming over? First one, cash bank account debit to Naveen, to Vasant and to Chatterjee, 15,000, 41, 600 and 11,000, total of that 67,600. And next, Das is withdrawing cash, so Das capital to cash bank 3,500. All entries completed. Now prepare balance sheet. Again on your own I am giving you a simple hint. How to prepare a balance sheet. New capital is known to you, the distribution of 5,40,000 in 4 part. That is your capital. All assets and liabilities are available here in the first entry. All assets and liabilities. Capital is known, all assets and liabilities are here. Only care to be taken is change in this cash bank. Cash bank is debit here. In this entry also it is debit, and this entry it is credit. debits will be added and credit will be subtracted. Come on, prepare balance sheet on your own. Try out, it must tally. Come on, try. Look at the balance sheet. Liability side, new capitals. Creditors minus reserve for discount on creditors. Asset side, all assets coming from your first entry as I said you. And the last one, cash and bank, making plus minus. Your cash balance comes to 224,100. Your balance sheet tally is at 649,200. Clear? Advance accounts topic normally ranges between 8 to 16 marks. And roughly a short question in every paper of ICI. It is there in advance accounts, and we can call it as a format chapter. Yeah, the topic is divided in small parts also. And each small part can very well weightage in exams. We are going to talk about accounting of commercial banks. All commercial banks in India are governed by Banking Regulation Act and Reserve Bank of India. So, I can say that the apex bank of India is Reserve Bank of India, and along with Reserve Bank of India, the apex bank governing is Banking Regulation Act 1949. All Reserve Bank of India, apex bank and Banking Regulation Act, they govern what you call it as commercial banks, because what we are going to see is accounting of commercial banks only. Now, what is a commercial bank? In a rough idea, you can say that commercial bank is an organization which accepts deposits from the public. So, they accept deposit from public. This deposit becomes definitely a liability for the bank because it is payable by them. When the bank will accept deposits, bank will get money. From this money, some amount is subtracted and cash kept as CRR with Reserve Bank of India. After keeping CRR, bank will keep some SLR requirement by the Banking Act, statutory liquidity ratio. And after SLR, whatever money is left with the banking company, bank will utilize that in giving advances back to the public. Advances, you can say, giving loans back to the public, giving them funds. This advances given by bank becomes assets for the bank because it is receivable for the bank. And throughout the topic many a times, the question will use the word assets instead of advances. So, when they use the word assets, keep it into mind that they are your advances. So, accepting deposit, out of that money keeping aside CRR and SLR, and then giving advances back to the public is a primary function of a commercial bank. Now, when you talk about these advances and when you talk about these deposits are taken by the bank in 4 ways. There are 4 modes of deposit. 1, savings deposit, sometimes it is called as a time deposit. Next, fixed deposit, also called as term deposit. Third, current accounts, they are also called, because current accounts are such accounts where the businessman normally maintains his account, They can withdraw any amount of time, any number of times, and they can deposit also number of times. So, these current deposits are also called many times as demand deposit, sometimes also called as call deposit. And the last one, all of you know it very well, it is called as a recurring deposit, RD they are called as. When you talk about giving advances to the public, advances also are classified for accountancy subject in 4 categories. First one, cash credit given by the bank normally to businessmen. Same way, overdraft facility given by the bank to the public, to the shareholder, the part of deposit holders. More properly, overdraft is given to businessmen. Third, bank can give a term loan. And the last one, this one you have studied somewhere in your CA foundation, topic bills of exchange, discounting of the bill. What was discounting? The drawer was getting the money from the bank in advance before the maturity date. For that, bank was deducting some discount charge. Discount was nothing but interest on difference. So, third one. Now, the fourth, what I discussed just now is bills purchased and discounted. Bill is being purchased, drawer sells the bill, the bank will purchase it and discount it. So, bills purchased and discounted. Deposit of 4 types, advances of 4 types. So, this deposits which is taken by the bank, assume yourself now onwards that you are the commercial bank. This deposit taken by the bank, you have to pay interest on that. So, this deposits leads to an expenditure called as interest on deposits, and this interest on deposit becomes the expense for the bank. Likewise, this advances which is given by our bank to the people, to the businessman, to the public, yields an revenue, income for the bank, and that income will be coming in the form of interest, and I can call the word interest and discount. Discount why? Discount on this particular point, bills purchased and discounted. This interest and discount is income for the bank. So, that is what is a basic structure of a commercial bank. As far as our topic is concerned for the CA intermediate, we are going to study subtopics like number 1, revenue recognition for a commercial bank. Number 2 is accounting for rebate on bills discounted. Number 3, calculation of provision for loss, we call it as provision for doubtful debts also. Number 4, calculation of capital adequacy ratio. 5th, CRR calculations. 6th, accounting for investment done by the bankers. 7th, we will study how to prepare P&L account, and lastly, how to prepare a balance sheet of a bank. It's a bit of lengthy topic, also called as a format topic. Short topics, some topics will be there here. I take the first and the simplest one, carrying weightage of 4 marks, and that is this one, revenue recognition. Now, students, what do you mean by a revenue recognition? Revenue means income, and second word is recognition. Recognition means recording. So, when you say revenue recognition, it means revenue, income, recognition means recording. So, recording of income. By now you know it very well. What is the income of the bank? Interest and discount. So, how does a bank record that in their books? For understanding that, bank guidelines is Banking Regulation Act of, part of it is that income to be recorded by your bank in your books of account will depend upon that income is generated from which advance. See, I already told you here that these advances are also called as assets. So, revenue recognition principle says that revenue recognition will depend upon the type of asset. Type of asset means type of advance. For that, it is classified into two parts. First part says performing assets, and second part says non-performing assets. You might be reading in newspapers every now and then, non-performing asset, NPAs, the biggest burden, a headache for Indian banking system. Now, coming to our subtopic, revenue recognition, recording of income. If income is generated by performing asset, it should be recorded on accrual system. And if income is generated by non-performing asset, it should be generated by, recorded by, recognized by cash system. What do you mean by accrual system? Accrual system means you should record in the books interest and discount received plus receivable. Receivable means what? Even outstanding can be recorded, provided that is income generated from a performing asset. For a rough idea, I can say performing asset means those advances which are regular advances. They are paying your bank installments and interest in time. They are not normally making a default. Non-performing assets are bad debtors. Cash system means what? You should record only and only interest and discount received. The word receivable is not considered for NPAs, non-performing assets. This one I can also say receipt plus receivable means what? I will record interest earned. So, for performing asset, it is interest earned, and for non-performing assets, it is interest received. Receivable should not be recorded. This was a brief idea for our question number 1. Every subtopic when we start, there will be different idea given to you, and from that idea we will proceed ahead. So, that completes introduction of banking company. Thank you. Now, we start with a new topic, accountancy, paper 1. Chapter's name is fire insurance claim. So, name of the chapter, fire insurance claim. Remember, adjustment used to have somewhere in 11th standard accountancy, final account chapter, a common adjustment. Goods of 10,000 are destroyed by fire. An insurance company have decided to give you a claim of 8,000, something like that. So, there is a loss of 2,000. We are going into depth in this chapter. How do we calculate all these things? First of all, a businessman's shop or godown catches fire. Definitely he will have a loss. The losses are classified in two categories. So I can say loss by fire are of two types. First loss is an immediate loss. Students, what do you mean by immediate loss? A loss which you can see apparently fire occurred, stock destroyed. A loss which is an apparent loss, an immediate loss. That loss, that immediate loss is nothing but loss of stock. Second loss. Students, because of fire, your shop, the businessman's shop will remain closed for renovation work and all the things. Say for example, for 1 month the shop remained closed. So if shop is closed for 1 month, his sales will be zero. And if sales is zero, he is losing sales and thereby he is losing the profit which he would have earned in that sales. So second loss is a consequential loss. What do you mean by consequential loss? A resulting loss. And we call it as loss of profit. So businessman, due to fire, the losses are classified in two parts. One, loss of stock, an immediate loss, and second, loss of profit, a subsequent loss, a consequential loss. First, we will focus on loss of stock. We will first solve examples on loss of stock and then we move to loss of profit. Coming to loss of stock, that adjustment of 11th standard. Goods of 10,000 destroyed by fire. Now, first question comes is how the trader, the businessman will come to know that my goods of 10,000 are destroyed by fire. Answer is simple. He will try to find out what was the total stock lying in his shop when godown caught fire. So for example, he calculated and he got the answer that total stock on date of fire, I shortly call it as TSF. Total stock on date of fire, for example, is rupees 10,000. Fine. He found out by inventory record or by from seeing his trading account. From goods, total of 10,000 were lying in your shop when it caught fire. But naturally, anyone when his shop catches fire, he will always try to save some goods, evacuate something from that. I assume that out of 10,000, he saved goods of rupees 3,000. So from 10,000, his loss comes down by rupees 3,000. These goods saved from fire are called as salvage. So from TSF, I will subtract salvage. Total goods lying in godown were 10,000. From that, goods of rupees 3,000 were saved from fire. What does this mean? Goods destroyed by fire, stock destroyed by fire is rupees 7,000. So third one will be stock destroyed by fire. I will shortly call it as STF. These three lines we wrote. Total stock on date of fire less salvage is equal to stock destroyed by fire. This line is technically called as statement of claim. So statement of claim will say total stock on date of fire, say 10,000, goods saved from fire 3,000 and hence stock destroyed by fire is 7,000. he will lodge a claim with insurance company of rupees 7,000. Before passing the claim, insurance company will verify what amount of policy he possesses. So next step is to compare the policy amount, and policy amount will be compared with the value of asset. Value of asset is nothing but total stock on date of fire. Let's try to find. Three cases are possible here. What is my total stock on date of fire? It is 10,000. Assuming that the policy amount is 15,000. So can I say policy amount is more than the amount of asset, amount of stock, and hence this particular case is called as over insurance. We have insurance sufficient amount, and hence in this case of over insurance, what amount you will receive from insurance company as claim will be your total stock destroyed by fire. Look at what was the stock destroyed by fire? 7,000. So insurance company will give you full amount, 7,000 as a claim. Going ahead, case 2. I am presuming policy amount was 10,000. Our TSF is also 10,000. What does this mean? Policy amount is just same as amount of stock lying in your godown. We will call it as a complete insurance. Technically, we call it as full insurance. Think of full insurance. So how much amount will we get? Again, we will get the full amount of loss. So your claim will be 7,000. We come to and typical case. Suppose a businessman is bit miser kind of person. He thinks why to take so much of huge amount of policy, because if policy amount is high, you have to pay more premium. Is fire going to occur every time and then? No, let us take a risk. So he takes a very small amount of policy. I presume he takes a policy of rupees 5,000. Your value of asset on the date of fire? 10,000. Can I say, students, that this is a case of under insurance? In this case of under insurance, insurance company will not give you a full claim. If you see, policy amount is 5,000, value of asset is 10,000. So can I say policy is of half the amount? Your insurance cover is not a complete insurance cover, it is half insurance cover. So if it is half insurance cover, insurance company will also give you half the amount. What do you mean by they will give you half the amount? Your loss is how much? 7,000 rupees. Half of 7,000, that means they will give you a claim of 3,500 only. This proportionate calculation, that what is the cover you are getting of insurance, and according to that cover we will give you a claim. This is technically called as average clause. So this proportionate calculation, because your insurance was not fully covering the amount of the stock, insurance company gave you a proportionate claim. This calculation of proportionate claim is called as average clause in the language of insurance business. You know the word clause. What do you mean by clause? Clause means one of the terms and condition of an agreement. You must have studied in mercantile law subject. Insurance policy is an agreement. It's a contract. So all different provisions, terms and conditions in insurance agreement, insurance policy is called as clauses. This one is called as average clause. Average clause is applicable only when there is a case of under insurance. This 3,500 which we calculated, let's convert it in a simple formula. How we got that? So, claim under average clause is equal to, I will write in the numerator policy amount, in the denominator I will write the amount of TSF. In our example, policy amount 5,000 divided by TSF 10,000, that gives you 50%, and that will be multiplied by the STF. What do you mean by STF? Stock destroyed by fire, which was 7,000. So, three cases are possible: over insurance, full insurance, and under insurance. If it is under insurance, you have to apply average clause. So, two things we had studied: statement of claim and comparison of policy amount with TSF. We go ahead now, understanding the next part. My statement of claim started with the word total stock on date of fire 10,000. Question comes, how will I find? Say for example, current year started on 1st April, and on 10th August you go down, catches fire. So you need to know what was your closing stock on 10th August. We call it as stock on date of fire. How to find it? Simple thing. We will prepare a trading account for this period. Which period? From the date of beginning of the year to date of fire. So I will prepare a trading account. A trading account from which date to which date? From date of beginning of the year to date of fire. Trading account always will have a debit and a credit. In our example, what is date of beginning of the year? My date of beginning of the year, assume, is 1/4/2019. And what is date of fire? I am assuming 10th August 2019. So my trading account will cover figures from 1st April to 10th August. Why am I preparing this trading account? With an intention to find out what is my total stock on date of fire. So, but naturally this is not the trading account concerning your final account. Hence, we will give a distinctive name to it. So, what I write is, instead of trading account, I will call it as a memorandum trading account. What do you mean by memorandum? Memorandum has different meaning. Meaning number one, it is not forming part of official books of account. It is a simple working note. Working note prepared for a specific objective is a memorandum account. This one, the objective is to find out total stock on date of fire. Just prepare it. Your format, you all know it very well, how to prepare, right? Simple trading account, the format will be say a rough trading account I am preparing here. We will start with opening stock. That opening stock is nothing but last year's closing stock. Then I will write to purchases. Say for example, purchase minus purchase return. So I will get net purchases. Then any of the direct expenses like carriage inward, octroi, wages, etc., etc. Credit side, sales minus sales return will give you net sales. All other items on the credit side will be all goods going out of the business other than sales. What do you mean by goods going out of business other than sales? Goods withdrawn, goods distributed as free samples, goods given as charity, goods sent on consignment, goods sent on sale or return, goods stolen away, anything. Goods going out of the business other than by way of sales. Short form I'll use is GGO, goods going out, will come here. My target is to find out what? The stock on that day. So instead of using the word closing stock, because this is not the year end, so instead of using the word closing stock, I'll call it as by total stock on date of fire. And this is our target to find. So this is my balancing figure. This is yet to be found out by me. Now think of how can I find? Answer is simple. Every businessman knows his GP. Remember CA Foundation, a chapter was there, sale or return. They used to give you sales ratio, GP ratio. Here also they will give you gross profit ratio. Gross profit ratio is the relationship of gross profit to sales. So on this sales on the credit side, I will apply on the debit side to gross profit. Certain percentage on sales will be given in the question. If they give it on cost, you can easily convert it into sales. You know it very well, students. On that, I'll calculate. Last step is to make totals. My definite debit total will be heavier. So I'll first write debit total, I'll write the same in the credit, and then I'll subtract the credit figure so that I'll get total stock on date of fire. And from that total stock on date of fire, I'll go to first one, statement of claim. This figure, I will get total stock on date of fire. Clear, everyone? Let's go one step ahead. I said you that question will give you this GP ratio. I presume GP ratio is 20% on sales, is given in the question. Which is this GP ratio? Definitely this has to be GP ratio not of the current year, because current year is not yet over. So this has to be GP ratio of either previous year or some average of past years. So every time we have to presume that GP ratio of last year and GP ratio of current year is remaining same. That assumption you have to write every time. Clear, all of you? Okay. Going ahead. Suppose question doesn't give you GP ratio of last year. 20% figure is not given in the question. Then what to do? Then we can easily find. How do I find? My formula for finding GP ratio is GP divided by sales multiplied by 100. GP of last year divided by sales of last year multiplied by 100 will give me the answer. And after finding this GP of last year, I will write assumption. What is my assumption? That I am presuming that GP of last year and GP of current year of fire remains the same. Sure till this stage? Going ahead. Suppose question is silent about GP and sales of last year. Then what to do? I have to go one step ahead. I will prepare last year's trading account. From that I will find out last year's gross profit and then apply this GP ratio. What do you mean by last year? So I will prepare a trading account for the year before the year of fire. You know it, how to prepare a trading account, simple. You already prepared it just now in memorandum trading. 2. opening stock 2, purchases 2, direct expenses by sales and sales return of last year, by goods going out in the last year, and by last year's closing stock. And last year's closing stock is current year's opening stock, you know it very well. When I make this total, the credit total will be heavier. I will find the difference. This difference is my gross profit of last year. And this gross profit of last year I will use at this place to find out GP, and this is the sales of last year. After that I will prepare a memorandum trading. So if you can understand the steps now. Step 1, you will see in the question, is GP ratio given or not? If GP ratio is given, your solution will directly start with memorandum trading account. Then why should I prepare a trading account? The objective of preparing trading was to calculate GP ratio. So I will directly start with memorandum trading. But if GP ratio is not given, then I have to start with trading. Clear? So step 1, see in the question, is GP ratio given or not? If given, start with memorandum trading. If not given, start with trading. If you start with trading, get the amount of gross profit and then calculate GP ratio by applying that formula. After GP ratio, we will prepare a memorandum trading. Gross profit ratio we will apply in memorandum trading. Balancing figure, as I already taught you, this is your memorandum trading. Balancing figure will be my total stock on date of fire. After finding total stock on date of fire, I will transfer that total stock on date of fire to my statement of claim, and this figure will go here. After preparing statement of claim, I will have this comparison. Comparison of what? Policy amount and TSF. It will give you 3 cases, you know now: over insurance, full insurance, and under insurance. Everyone clear? One more thing. In this statement of claim, when you subtract salvage, insurance company, as per the terms of agreement, will allow you to add in claim any legible expenses, any natural logical expenses which you incurred in extinguishing the fire, in controlling the fire. And there should be logical expense. So any expense incurred to extinguish the fire will be added in statement of claim. So in statement of claim, less salvage, and I will add expenses to extinguish fire. That we have to add. Do remember one thing, whether trading account or memorandum trading account, when you write stock, opening stock or closing stock, it is always at cost price. What do you mean by always at cost price? If they are overvalued or undervalued, then we have to convert them into cost. For example, if question says stock is overvalued by 10%, then how to find the cost? The cost will be nothing but the value of the stock into 100. When you say it is overvalued by 10%, so I will divide it by 110. If this is overvalued by 20%, I will divide it by 120. But suppose question says it is undervalued by 5%, then what to do? Simple. In that case, my denominator, instead of 110, it is undervalued by 5%, I will divide it by 95. So stock has to be at cost. The GGO, that credit side item I taught you just now here, this is a place, GGO. Goods going out, distributed as free samples, goods withdrawn, given as charity, etc., etc. These goods has to be recorded at cost only. To confuse you, they might give you at selling price. So if they give you at selling price, you have to convert it into the cost price, and you know it very well. From selling price, you subtract the profit margin, it will give you a cost. So summarizing, step 1, see whether GP ratio is given or not. If GP ratio is given, start with memorandum trading. If GP ratio is not given, start with trading. If you start with trading, first complete trading account, from that calculate gross profit ratio, then prepare memorandum trading, apply gross profit ratio in memorandum trading. Assumption is GP ratio of last year and current year remaining same. And then statement of claim, and lastly after statement of claim, comparing TSF with policy amount to find out whether it is over insurance, full insurance or under insurance. And if there is under insurance, one step ahead, I have to apply average clause. These are the basic theory concepts for calculating the sum, solving the sum on loss of stock policy. Yeah, we will have some internal more depth of it, different varieties of it, but the base for all loss of stock sums will remain the same. Okay, so concept coming to an end for loss of stock, go through the theory, then we start with the practical sums. Thank you very much, students. Thank you.